Europe today is a continent on the brink. France has gone through 4 prime ministers in a single year. Italy's government can barely survive months without collapse. Spain is paralyzed by nationwide strikes, and Germany, long considered Europe's industrial powerhouse, faces skyrocketing energy costs and declining competitiveness. Across the continent, bond yields are soaring, public confidence is evaporating, and citizens are losing faith in their political institutions. This chaos is not sudden. It is the culmination of decades of policy errors, austerity obsession, and economic stagnation. After the 2008 financial crisis, the United States chose stimulus. Trillions of dollars were injected into infrastructure, banks were saved, and innovation was funded, reigniting growth. Europe, on the other hand, under Germany's strict Black Zero policy, slashed public spending, delayed investment, and forced austerity onto its citizens. The results are catastrophic. Europe's share of global GDP has fallen from 20% in 2000 to just 14% in 2023. Productivity growth stagnates at 0.5 to 1% per year, compared to 2 to 3% in the US. Private sector R&D spending hovers at just 1.2% of GDP, barely half of US levels. Europe has produced 0 new 100 billion euros tech companies in the last 50 years. Meanwhile, the youth and talent are fleeing. Engineers, AI researchers, biotech innovators, and entrepreneurs are moving to America, Asia, and other markets where they can scale and grow. Europe is aging, politically fragile, and economically hollow. For Americans, this is not just a European problem. A weakened Europe destabilizes global markets, affects U.S. investments, and forces the U.S. to shoulder more of the world's military and financial responsibilities. Imagine if Europe cannot stabilize itself again. Who will bail it out? And at what cost? Citizens are angry. Rising living costs, failing public services, and disconnected political elites are fueling populism. Every decision from Brussels is now under intense scrutiny, creating political and economic instability that affects the entire world. While the US built Apple, Amazon, Tesla, Nvidia, and Google, Europe stagnated. Its largest companies averaged nearly a century old, tied to automotive and traditional manufacturing. Startups face suffocating bureaucracy, limited venture capital, and complex regulations. 1/3 of Europe's unicorns have already left for the US or Asia. Talent is leaving at unprecedented rates. Engineers, AI researchers, fintech innovators, and biotech scientists are emigrating to America for opportunity, freedom, and funding. US innovation hubs, Silicon Valley, Boston, Austin, New York have absorbed this talent, strengthening America while Europe loses its competitive edge. Economic numbers tell a harsh story. Europe invests 1.2% of GDP in R&D, compared to 2.5% in the US. Energy prices in Germany and France are among the highest globally, pushing industries abroad. Regulatory and bureaucratic hurdles stifle entrepreneurship. For the US, this is a strategic advantage: less competition, a stronger talent pool, and control over emerging industries like AI, semiconductors, and biotech. But it's also a warning. Europe's stagnation is structural, not temporary. Without reform, this trend will continue, creating permanent US advantages in tech, finance, and innovation. Investors, entrepreneurs, and policymakers must recognize this shift. Europe's declining growth potential affects global market dynamics, currency stability, and international trade, all of which are critical to US interests. Europe's political instability mirrors its economic crisis. Germany's energy policy, including the decommissioning of nuclear plants during the energy crisis, crippled heavy industry overnight. Factories closed, production slowed, and citizens' energy bills skyrocketed. Public frustration fueled the rise of populist parties across France, Italy, and Germany, now capturing nearly 30% of the electorate in multiple countries, a threefold increase since the 1990s. corruption scandals from Qatargate to Huawei. Investigations reveal systemic problems in governance. Citizens see Brussels as a distant, unaccountable bureaucracy incapable of addressing real problems. Expensive green energy mandates, immigration debates, and welfare reforms inflame public anger. Europe is politically fractured, socially tense, and economically fragile. For the US, this is more than a foreign story. NATO partners become unpredictable, weakening collective defense. Trade and investment agreements face increased risk. US investors experience volatility tied to European instability. Every European election, scandal, or policy misstep has direct consequences on US markets, trade, and global security. America must prepare for a continent where allies are unstable, policies are unpredictable, and the global balance of power shifts rapidly. The Eurozone's currency is under enormous strain. France's debt exceeds 350% of GDP. Germany's is about 200%. Yet both share a single currency. One ECB interest rate cannot solve such divergence. To stabilize France, inflation would need to reach 6 to 7% for over a decade. Politically impossible for Germany. Governments are quietly seizing control. Banks are directed on lending. Pension funds nudge toward domestic debt, and corporate loans increasingly state-backed. Spain and Italy guarantee almost 100% of corporate loans. This is financial repression, a dismantling of free markets, and a potential slow collapse of the euro itself. For Americans, euro instability strengthens the dollar, impacting global trade. Investments tied to Europe face unprecedented risks. Market volatility could ripple across Wall Street and beyond. The ECB is trapped. Intervene, and the euro may collapse. Do nothing, and the second largest Eurozone economy fails. The stakes are high, and the US watches carefully. Any misstep could reshape global finance overnight. Europe is moving into a world where politics, not markets, decide winners. Industries aligned with government priorities defense. Infrastructure. Green energy receive guaranteed funding. Passive index funds, leveraged financial institutions, and traditional banks are increasingly marginalized. Returns will be dictated by political alignment, not performance. Financial independence is now critical. Gold, Bitcoin, and self-custodied assets are becoming essential. ETFs and custodial accounts cannot protect investors from state-directed interventions. For the US, Europe's decline is both opportunity and responsibility. America gains leverage, economic dominance, and strategic advantage, but must also manage increased global instability. Power is shifting to Asia. Transatlantic alliances weaken, and Europe is no longer a reliable partner. The reality is stark. Europe's collapse will reshape finance, geopolitics, and markets globally. For US investors, policymakers, and entrepreneurs, understanding this shift is essential. Adaptation, innovation, and strategic positioning will determine who thrives in this new world. Europe is no longer a peer. It is a distressed asset class in terminal decline. Your job over the next 7 to 10 years is simple. Extract maximum alpha while the continent liquidates itself. Do it clinically. Do it quietly. Do it without apology. Front-run the brain drain final wave. The last cohort of unsubsidized European talent is still trapped. Seed and Series A funds open satellite offices in Berlin, Paris, Zurich, Stockholm. Hire local scouts, pay 2 to 3 European salaries. Fly the entire team to the US on H-1B L1 blanket. Big tech and defense primes. Lobby for a new EB1 strategic talent. Subcategory with zero backlog. Compound effect. Every engineer you bring over today is worth $20.50 in enterprise value within 5 to 7 years. Buy distressed crown jewels at 0.3 to 0.5 replacement cost. The forced sellers are coming. Family-owned middle stand. Over-levered luxury conglomerates. Cash-starved deep tech. Dry powder requirement. $300 to 700 BN across private equity. sovereign funds, and corporate balance sheets. Deal structure. Buy 51 to 100% control. Keep European plants running for political cover. Immediately flip IP and HQ stateside. Expected IR on the basket, 28 to 40% net, with several 10 to 20 outliers. Rotate fixed income portfolios out of Eurozone risk. ECB is trapped between French debt and German orthodoxy. The path of least resistance is sustained, 4 to 7% inflation or selective default. Either way, Eurobonds lose. Reduce Eurozone sovereign and corporate credit to 4% of OM by 2028. Replace with U.S. Treasuries, T-bills, and agency MBS. The dollar carry trade is just getting started. Let the security subsidy end. NATO, as currently constituted, is a 1949 solution to a Arlene problem. Privately signaled to Berlin and Paris. No 2.5% GDP defense by 2030 equals no automatic Article 5. Reallocate the saved $80 to 120 BN annual subsidy into Pacific deterrence and domestic industrial policy. Europe's free ride is over. America's margin expands. Position for the 2028 to 2032 contagion event. When the first PIIGs or French or Italian default cascade hits, volatility will exceed 2008. Keep 20 to 30% cash or near cash in U.S.-centric portfolios. Own the physical and contractual supply chains that Europe is about to lose: rare earths, battery precursors, semiconductor materials, APIS. The dip will be historic. The recovery will be American only. Bottom line for the only audience that matters. Europe has chosen managed decline. America did not force this outcome. Europe volunteered for it. Your fiduciary, strategic, and patriotic duty is identical. Harvest the talent, acquire the assets, secure the supply chains, and let the dollar finish the job. This is not tragedy. This is the largest wealth and power transfer since 1945. Happening in slow motion and in plain sight. Move faster than your competitors. Leave nothing of value behind. The American century was paused, not canceled. It resumes now. Execute. Europe has now entered the terminal stage. The political class is paralyzed. The debt markets are blinking red, and the smartest locals are already packing. What remains is pure distressed value, and it will be stripped clean in the next 5 to 8 years. Here's the exact roadmap for the only people who still win from Europe. Harvest the final 150,000 to 200,000 unsubsidized STEM workers. These are the ones who didn't leave in 2018 to 2024. They are now desperate. Pay 48-hour relocation packages plus instant family green cards. Cost per head $150, 2 to 5 OK. Lifetime NPV $15 for OM. Do it at scale. Acquire the hidden champions basket at 3 to 5 times EBITDA. German, Swiss, Austrian, Northern Italian. Family firms are facing succession plus energy death. Average deal €80 for OOM at 60. 70% discount to replacement cost. KKR and Blackstone are already raising €200 billion plus vehicles. Beat 'em to it. Buy sovereign real assets on the way down. Ports Rotterdam, Piraeus, Grids Terna, toll roads, airport stakes, all coming to market quietly. Load up at 2030 US cap rates while cash flows are still in euros. Short euro credit. Go long dollar duration. Overweight 10 to 30 years treasuries. Short IGHY Euro CDS. Own TLT plus Bitcoin. When the first country loses market access, the move will be one directional. Position for the breakup trade 2029 to 33. Buy Italian BTPs at 200 to 250%. Yield when spreads blow past 800. Own gold, Bitcoin, Swiss francs. Nick Texas real estate as redenomination hedges. Lock in critical materials before the plants shut. Cobalt refining, lithium hydroxide, rare earth separation, pharma apis, 30 to 60% still in Europe. Sign 10-year off-takes today or build the plants in Nevada tomorrow. The only moral left, Europe lived off American capital and security for 80 years while lecturing everyone else. The bill is due. There will be no third Marshall Plan. When the history books close, the final line will read, everything of lasting value that Europe still had in 2025 was legally transferred to American ownership by 2035. This is not vengeance. This is compounding. Europe bought the museum ticket. America is just buying the exhibits before the lights go out. Execute without sentiment. The liquidation has entered its final phase. Move!